Today's financial market update, the most important market insights and investment ideas you need to know. Market sentiment is bearish, moderate. Market is declining across major indices. Index performance, S&P 500 at 1.43%, Dow Jones at 99.91%, Nasdaq at 1.85%, Russell 2000 at 2. The stock market is facing a cautious decline due to rising inflation concerns and geopolitical tensions affecting investor sentiment. The cautious decline in the stock market signals a need for investors to remain vigilant and assess their portfolios amid external economic pressures. Consider reallocating funds towards GWW, as its strong growth potential in the gaming sector may present lucrative investment opportunities. Major asset managers, including State Street and Voya, are reallocating investments from corporate bonds to mortgage bonds. The shift to mortgage bonds indicates a growing sentiment among investors that corporate debt may face increasing risks amid inflation and geopolitical tensions. Consider allocating a portion of your portfolio to mortgage bonds, as they may provide stability during inflationary periods and economic uncertainty. Geopolitics Therapeutics has cut its net loss to $266 million, but it still needs ongoing funding for operations. The reduced loss at Geopolitics Therapeutics suggests improving financial management, though investors should watch for funding developments before committing. Consider monitoring Geopolitics Therapeutics for potential buying opportunities if funding news indicates stability or growth in the near future. Global markets have faced a 4-week decline, reflecting heightened concerns over geopolitical tensions and economic stability. The decline in consumer confidence signals potential reductions in discretionary spending, which could lead to slower economic growth. Consider defensive stocks in sectors like utilities and consumer staples, as they tend to perform better during economic downturns. The effective federal funds rate decreased from 4.33% in March 2025 to 3.64% in February 2026. A lower federal funds rate reduces borrowing costs, making loans more accessible for consumers and businesses, which could stimulate economic activity. Consider increasing allocations to real estate investments, as lower borrowing costs can drive home purchases and property values higher. Inflation concerns are rising due to the ongoing Iran war, impacting consumer confidence and spending patterns. Rising inflation typically erodes purchasing power, leading investors to be wary of consumer-driven sectors that may face declining demand. Consider defensive stocks in utilities and consumer staples, as they tend to perform better during inflationary periods and economic slowdowns. Oil prices have risen sharply, with Brent crude trading above $90 per barrel amid heightened Middle Eastern tensions. The surge in oil prices signals potential economic slowdowns, as higher energy costs may lead to reduced consumer spending. Consider diversifying portfolios with energy stocks or ETFs that could benefit from the rising oil prices in the short to medium term. The Indian rupee has depreciated to 93.71 U, reflecting the impact of rising oil prices. The depreciation of the rupee indicates a direct correlation with rising oil prices, signaling potential for continued currency instability. Consider diversifying into oil-exporting currencies, as they may see appreciation amidst rising oil prices and geopolitical tensions. The war in Iran has led to escalating tensions in the Middle East, impacting global stability and market sentiment. Investors should recognize that geopolitical conflicts often lead to heightened market volatility, requiring a cautious but informed approach to asset allocation. Consider diversifying into safe haven assets like gold or government bonds, which tend to perform better during periods of geopolitical uncertainty. The Westwood Salient Enhanced Midstream Income ETF, MDST, has 80.6% exposure to the U.S. energy sector, focusing on key players like Enbridge and Energy Transfer. Rising oil prices intensified by geopolitical tensions indicate a potential long-term shift in energy sector dynamics, which may impact investment returns. Consider increasing exposure to the Westwood Salient Enhanced Midstream Income ETF, MDST, to capitalize on its strong U.S. energy sector positioning. China is enhancing its status as the factory to the factories, significantly boosting Southeast Asian manufacturing capabilities. The shift towards Southeast Asia for manufacturing may diversify supply chains, but it also increases vulnerability to regional instabilities that investors should monitor. Consider diversifying portfolios to include Southeast Asian manufacturing stocks, as they may benefit from China's evolving supply chain strategy. Major investors, including State Street and Voya, are reallocating funds from corporate bonds to mortgage bonds. The shift from corporate to mortgage bonds signals growing concerns about credit risk in the corporate sector amid economic instability. Consider reallocating a portion of your fixed income portfolio into mortgage-backed securities to enhance stability and mitigate risk. Realty Income has formed a $1 billion joint venture with Apollo, acquiring a 49% stake in retail properties. The joint venture reflects Realty Income's proactive strategy to enhance its investment portfolio despite rising mortgage rates, signaling resilience in a tough market. Consider investing in Realty Income as a potential source of stable passive income, particularly in a volatile real estate market. Realty Income has initiated a $1 billion joint venture with Apollo Managed Funds to acquire retail properties. This joint venture signals a proactive approach by Realty Income to capitalize on growth opportunities, even amid market volatility. Consider allocating a portion of your portfolio to Realty Income for exposure to dividend-yielding real estate investments in a turbulent market. Alphabet Inc. shares are experiencing volatility amid ongoing discussions surrounding AI monetization and increased regulatory scrutiny. The volatility in Alphabet's stock reflects broader concerns in the tech sector about how regulatory developments may hinder AI monetization efforts. Consider investing in Ecolab, as its acquisition could lead to increased market share and revenue growth within the AI-driven cooling sector. Geopolitical tensions have increased, leading to a 15% rise in market volatility over the past month. Investors should recognize that rising volatility often signals increased risk, making it essential to adopt a cautious approach in their asset allocation. Consider diversifying portfolios by allocating a small percentage to established cryptocurrencies like Bitcoin and Ethereum to hedge against inflation. NextEra Energy (NEE) has experienced a stock rise of 26% over the last 6 months, fueled by increased electricity demand from AI data centers. The significant stock growth of NextEra Energy signals strong market confidence in the renewable energy sector, suggesting a robust demand trajectory driven by technological advancements. Consider adding NextEra Energy to your portfolio, as its projected upside of 25% aligns with growing electricity demands from AI and other sectors. Thank you for watching. FERPA, your financial Sherpa.